Okay, so we're going to start this 2081 financial accounting with chapter 1. All right. Um, and so this is a course in accounting. Um, and chapter 1 really is a foundational chapter. Um, and we're going to try to drive home the importance of accounting. All right. And this slide kind of lays out the activities that we'll be doing um, in the earlier parts of the term. All right. So identifying when a transaction has occurred. Some are obvious, like on the screen it says the sale of an Apple iPhone. Obviously, that's a transaction. Um, when an iPhone is sold, the seller, it could be Apple Computer, it could be Best Buy, has to record that on the books. So the first step is just identifying when transactions have occurred. Some transactions are more difficult to identify, and we'll spend a good amount of time kind of figuring that out. All right. Recording. This is where, if you've ever heard accounting, chances are you've heard the term debits and credits, and this is that. So we'll spend a lot of time dealing with debits and credits and recording transactions. You see the arrow from, let me put a laser pointer, the arrow. So once you've identified a transaction, the next step is determining how we'll record it. All right, and this is double entry accounting, which means every transaction is going to affect at least two accounts. It could be more, but a minimum of two. All right, and then periodically, we're going to communicate the results of operations. And this really is the financial statements. So most businesses issue financial statements monthly and quarterly. Monthly internally, publicly traded companies, which are your larger companies, issue quarterly financial statements that are publicly available through SEC.gov. And virtually all entities, businesses, are going to issue annual financial statements, and we'll be able to prepare rudimentary financial statements by the end of chapter 2. All right. Okay. So we want to think of who's using the accounting information. All right. Um, there's a good chance, in my conversations with students, it's often referred to that accounting is a math course. And I disagree with that. All right. Accounting is really more like a language. We said on the previous slide, the end result is that we're communicating, albeit with numbers, but we're communicating the results of operations. Did the company have a good year? Did they have a bad year? Did they make money? And we're communicating, by and large, to two categories of users. External users, all right, which could be lenders, shareholders, which means if I own stock in a company, I'm an external user. I'm waiting for that annual report to see how the company did. Auditors, right, which are external compliance, helping to ensure that financial statements are accurate. Governments, because governments like to tax companies, so governments are also external users of the financial statements. All right. There are also internal users, and internal users of the financial statements are typically decision makers within any organization. All right, so we'll get a little bit into this semester, but you're going to get knee deep in accounting for internal decision support in 2082, which is your managerial accounting course that many of you will be taking in the future, presumably next term, spring 22. Ethics. So um, there have been high-profile accounting failures. Accountants who were unethical in the way they did their job. All right. Um, and so suffice it to say that ethics is a big part of accounting because you want to be able to trust the financial statements, because for most companies, all you're going to see from their operations is a set of financial statements. So they need to be ethically prepared and accurate. And Enron was an example of an accounting failure where the accountants failed to act ethically. Right. So we'll talk periodically about accounting ethics and how they affect the job that accountants are doing. All right. So what we're seeing here is the fraud triangle, which is a tool that auditors use to determine when unethical accounting decisions are more likely to be present. So there are three legs of the fraud triangle, and they are opportunity, rationalization, and financial pressure. So opportunity you want to think of as the chance to commit a fraud. Like if I'm in control of a bank account and I can go to the bank and withdraw money, that's an opportunity, right? Because the company has listed me as an authorized user on their bank account. Rationalization. Well, that's internal to the person who would be perpetuating a fraud. So am I able to justify stealing money from the company? Like a rationalization would be, I'm underpaid. So I'm just evening the scales, so to speak. And financial pressure. So these can be things like, kids going to college. I've got tuition bills. It can be unplanned illness, medical bills. All right, those are examples of financial pressure. And so the reality is that when at least two of these are present, fraud is more likely to occur. And when all three are present, fraud is even more likely to occur. Sarbanes-Oxley, which is, so I always say at this point, if pro is the opposite of con, what's the opposite of progress? And then, of course, the answer to the joke is Congress. Sarbanes-Oxley was legislation passed by Congress, right? And it's named for the two congressmen that passed it. And it was passed in the light of several high-profile accounting failures, all right, accounting abuses. And so we see several of those here. Enron, I mentioned a few minutes back in the slides. WorldCom actually came after Enron and was by magnitude an even bigger fraud, right? And the list goes on. But the common thread amongst these is that people lost a lot of money when these companies went bankrupt due to the accounting fraud. And so Congress enacted Sarbanes-Oxley to change the way external auditors ensured compliance with accounting standards, generally accepted accounting standards. And it also changed the way companies did their accounting internally. In fact, Sarbanes-Oxley took the accounting profession from a privately policed profession to one subject to substantial governmental oversight. Yeah, these are the rules that we're going to be learning this entire semester. Generally accepted accounting principles, or GAAP. So that's an acronym we want to get familiar with because we're going to see it a lot this semester. All right. Everything we're going to learn this semester is GAAP, right? Everything you'll learn next semester in 2082 is not necessarily constrained by GAAP, but everything we learn this term is GAAP, the rules in which we use to record, identify, record, and communicate the results of operations. All right. So what is the purpose of GAAP? All right. So to make information relevant, that is, I have the information needed to make decisions. If I'm a lender, do I have the information needed to determine whether I want to lend money to the company? Or if I am a shareholder, do I have the information needed to determine if I want to sell my stock, sell my shares, or do I want to buy more, or do I want to keep what I have? All right, so that's relevancy. Reliable. Well, we really only have to think back a few minutes in the accounting failures slide. So when we have a set of financial statements, we want to be able to look at it and know and trust that information is reliable. All right, and comparable. So when we think comparability, we want to think of consistency. So this allows me to compare. If I say, let's say I own Apple stock. All right, so I can look at Apple stock results from 2019 and 2020 and see whether Apple had a better year in either of those 2 years. That's the comparability, right? And that's what we call vertical comparability, all right? Also, if I want to look at Apple stock and compare it to one of their competitors, let's say Samsung. Well, both companies use GAAP, all right, to compare their financial statements. So I can look at Apple's financial statements and then look at Samsung's financial statements and determine which company had a better year. All right, so that's what we call horizontal comparability. And that's the purpose of GAAP, to make information relevant, reliable, and comparable. All right. GAAP is built on principles. So let's talk about some of those principles. We also have assumptions, which we'll detail, and constraints. All right. So the principles. The first is the measurement principle. In my textbook, back when dinosaurs roamed the earth, it was referred to as the cost principle. All right. So the cost principle really just means that the accounting system reports on what things cost, which is considered objective. An example of this is if you buy land and you pay $100,000 for a piece of land, well, that's a $100,000 asset. All right. Well, land typically appreciates in value. So if you've held the land for 5 years, it may now be worth $115,000. But on the accounting records, it's going to be reported at cost because cost is objective. And that's a general principle. There are some instances in which we divert from that. Those typically for this class we won't have to worry about. The accounting majors, however, will get deeper into that in the intermediate sequence. But that's the cost principle. We report things at what they cost. All right. Revenue recognition principle. This says that we recognize revenue when it is earned. All right. It doesn't mean you've already collected the cash. And so, when is revenue earned? Well, the short answer is when the company has provided a good or a service. So just kind of stick a pin in that, because it's going to be abstract until we get into chapters 3 and 4, and that's okay. But we'll come back to the revenue recognition principle. Expense recognition principle is very similar to the revenue recognition principle, but it relates to expenses. All right, so expenses are recognized when they are incurred. All right, and that's the expense principle, sometimes called the matching principle. And as an example, again, we'll get much deeper in subsequent chapters very soon. If I have a power bill, all right, that shows usage. I have a power bill from Duke Energy that shows usage for the month of August. All right, I don't have to pay that bill until the 20th of September. All right. However, I'm going to recognize at the end of August the amount of utility expense from the statement. Right? It doesn't matter that I haven't paid for it yet. The company has incurred an expense. It used power, and so for that reason, it has to record an expense. Right? It doesn't matter that the cash hasn't yet been sent to Duke Energy. All right. And so the next principle is full disclosure. All right. So, and I'll put up a set of financial statements in class. But if we look at financial statements, we'll see that there are 4 basic documents, and actually they're usually relatively simple. It's a income statement, balance sheet, statement of owner's equity, and a statement of cash flows. All right, so those are your 4 basic financial statements. But if we look, we'll see footnotes to the financial statements, and often the footnotes go for pages and pages and pages, and that's because of the full disclosure principle. We'll look at some footnote disclosures and see the types of things that companies commonly have to disclose. But an extreme example would be, let's say a company has a catastrophic fire on January 2nd. This is a company that has a December 31 year-end, fiscal year-end, and on January 2nd, following the end of the fiscal year, they have a catastrophic fire and virtually all of the company's capability to generate income is destroyed. Well, none of that would be reflected in the actual financial statements because they reflect a period that ended before the catastrophic fire. However, not reporting the fire would be misleading. If you were a stockholder and didn't know about the fire, you would be very disappointed when you realize that the company no longer could generate money. So the company is going to have to disclose that shortly after the financial statement date, we had a catastrophic fire that destroyed substantially all of the company's ability to generate income or to generate revenue. And that's full disclosure. It's supposed to allow for a company to, I'm sorry, for external users to make full and clear decisions. All right. The accounting assumptions. So we have our going concern assumption. And this is simply assuming that the company will continue to operate into the foreseeable future. All right, that's the going concern assumption. The if we just assume that, right? Because we know that businesses can and do go out of business, but for the purposes of the financial statements, we're going to assume that the company will continue to operate into the foreseeable future. All right. Monetary unit assumption. All right. So this is quite simple. We express the results of operations in monetary units. It can be dollars, it can be Swiss francs, it can be euros, it can be the yen, it can be any currency. But it has to be, the results of operations are expressed in monetary units. For most of our purposes, it's going to be dollars. All right. Business entity assumption, which assumes that the business is separate from its owners and its accounting records are separate. So if the owner of a business pays rent, that should be from a personal account as opposed to a business account. Right? We shouldn't see personal transactions in the records of businesses. And the time period assumption. So we assume that businesses' operations can be divided into artificial time periods, namely months, quarters, and years. All right. And those are the periods for which we'll see financial statements. Every company issues annual financial statements. Public companies issue quarterly financial statements, and internally, most companies are going to produce monthly financial statements. All right. Quickly, we'll just discuss some constraints. All right. So in class, we will look at financial statements. And one of the things that you'll notice is that oftentimes the financial statements are presented in thousands. All right, if we look at Walmart, the financial statements are presented in thousands. What does that mean? Well, Walmart doesn't present numbers. I mean, they're rounded to the nearest thousand because, well, $100 is not material one way or another when making a decision as it relates to Walmart. All right, so it's not material. All right, and you'll never see change on a financial statement for a large company. You're not going to see, $68 billion and 42 cents, right? Because the 42 cent is not material. It doesn't matter. All right, so that's an example of materiality. Cost benefit. All right. So as it relates to information and its reporting, only information that the cost to assemble and report on is going to be assembled and reported on. All right. There are some information, some transactions that are the cost of reporting on does not exceed their benefit. So that's the cost benefit constraint. All right. So those are your GAAP principles. we're getting close to the end of chapter 1, which is a fairly dense chapter in that it's more qualitative. But the accounting equation is something that we will see, we'll be working with really for the rest of the semester. All right, and so in double entry accounting, this must always be true. All right, so assets equal liabilities plus equity. All right, and if you want to think of an acronym, you can think of ALE, which is ALE, fancy word for beer. So anytime a transaction is recorded, it's going to affect one or more accounts. All right. And what we'll find in the chapter to come is it could be two asset accounts. It could be an asset and a liability, an asset and an equity. But before and after every single transaction, this equation must hold true. All right. Assets. What are assets? Assets are things of value to the company, things the company owns or controls. All right. Liabilities. Well, what are liabilities? Liabilities are things, amounts of money owed, are obligations of the company to third parties. So if a company has, an example I used just a few moments ago, the Duke Energy bill, right? It comes at the end of the month. It's not going to be paid until 20 days later. Well, that's a liability. That's what we call a payable. All right. Equity. So equity is the residual. It's the owner's claims against assets. So if we look at this equation, assets is on this side by itself. All right. So if we think of liabilities as the claims of third parties against assets, then equity is the claims of owners against assets. Another way to articulate that is if the company ceased doing business today, they'd obviously have to pay all the bills that were due, and whatever is left over, whatever money would be left over, would be the owners to keep, and that's equity. All right. Equity has a lot of component pieces that we'll see. We kind of see here contributed capital plus retained earnings. And real quickly, because we'll get deeper in this in chapter 2, contributed capital, if I'm an owner and I invest in the company, that's contributed capital. All right. Whereas retained earnings are well, as the name indicates, these are the earnings from prior periods. All right. Common stock is like investments in the company. Dividends are really money paid to common stockholders. That's also a component of equity. We talked briefly about the revenue, our revenue, when we discussed the revenue recognition principle. When a company does something, a company has sold a good or provided a service, that's a revenue. All right. And expenses are what the company incurs in the generation of revenue. So these expenses keep the lights on. Expenses help manufacture the products, and the difference between revenue and expenses is net income. All right. So that's a quick fly through. We'll dissect this further, so don't panic if that is still a bit abstract at the moment. All right. Last slide for chapter 1. We're going to talk about the 4 basic financial statements, 3 of which we're going to be preparing very soon. All right. Income statement, which is a demonstrates revenues earned over a period of time and expenses incurred during that same time. That's your income statement. Your basic format for your income statement is revenues less expenses gives you net income. All right. Statement of retained earnings. This is a roll forward. So when I say that, all that really means is we'll start with the balance at the beginning of a period. So if we have a company that has a 12/31 year end, that statement will start with the balance in the retained earnings account at 12/31. And actually, why am I saying 12/31? If we have a company that has a 12/31 year end, the beginning balance in retained earnings is going to be January 1st, i.e. the first day of business, right, in that year. And the ending balance is 12/31. So we'll see increases from net income to rate retained earnings, or decreases due to net loss or dividends paid. All right. The third is your balance sheet. All right. So your balance sheet is it's really the accounting equation personified. All right. So total assets, as it's more of a snapshot. So both the income statement and the statement of retained earnings show change over a period of time, whereas the balance sheet is as of the last day of the accounting year. All right, or the accounting period if we're doing a quarter or a month. And of that, at that date, we'll quantify total assets, all right, and we'll quantify total liabilities and total equity. And if we've done it right, they'll equal. So total assets would equal total liabilities and total equity. And again, still abstract. We're going to spend time in class constructing the balance sheet. All right. The last, which we'll get to towards the end of the term, is a statement of cash flows. Right. And so this will make more sense after chapters 3 and 4. But because of the revenue recognition principle and the matching principle, it is possible for a company to show net income and never generate positive cash flow. And companies are kind of like, cash to companies is kind of like blood to you or me. You can exist without it for a period of time, but not very long. So companies need to generate income, but they also need to generate positive cash flow. All right, and that's the statement of cash flows. It demonstrates whether the company is generating cash flow or not, positive cash flow or negative cash flow. And the reality is that companies can only generate negative cash flow, i.e. spending more cash than they have for a period of time. Okay, so that's it for chapter 1.